3, 2, 1. Good morning, traders and investors around the world. Welcome to this Wednesday, January 26th edition of Pre-Market Prep with StockOdds. Joel Elconin joined by Rob Friesen. And we've got a volatile session going on. Currently up, let's just call it 45 handles at 43.94. We did take out that pre-market high and got over Monday's high by 10 handles, but stalled at 44.37. Now we're back under 44, anxiously awaiting the Fed announcement later on today. Crude, that's making a new high for the move, up $1.49 at 87.09. Gold not having a good day. That's down 18.30 at 18.34.10. Silver's in the red by 8 cents at 23.82. Bitcoin working its way back towards that old support, new resistance up at 40K, 41K. And Ethereum's having a better day on a percentage basis. That's up $178 at $2,613. I'm going to stop the screen share, bring in Rob Friesen here. And Rob, how you doing on this, should we call it Wacky Wednesday?
Yeah, it's interesting when you get these big moves and these reversals, right? And then Fed Day. So, I mean, one point I wanted to make is if you're in certain types of days, there is going to be more an element of uncertainty. Like we can guess at it. We can go look at the odds makers for, what is the percentage chance of a half a basis point hike versus a quarter, and you can look at all that stuff, but you still, at the end of the day, you don't know for sure, right?
Right.
And you don't, even if you knew for sure, you don't know exactly how the market would respond. So for example, we can go back to many events like Brexit or, the Trump election or whatever. It's like people were so certain that if this individual gets in, the market's going to tank, or and it goes on and on and on. So people have their level of certainty, but it's largely proven wrong. We've mentioned that before. The market loves to prove the most people wrong. I think it's its job. It's its number one job, right? So all we can do is live in the probabilities. And I have to reinforce again, I know it's like beating a dead horse, but boring stuff is beautiful, especially when you're in certain types of days or events where there could be more risk, more uncertainty, and you don't know how things are going to play out. But here's the key. If you can find things that are boring but could become more elastic during an event. So for example, on Wednesdays we have the oil and gas report, right? And those relationships in that same sector, they tend to move around a lot, become more elastic as the report comes out, right? Same thing with the Fed announcement. What's going to be more elastic, bouncing around is things that are interest rate sensitive. And I'm not talking about pairing one instrument that's going to be completely directional with one outcome and the other one going to possibly go the other way. I'm talking about two instruments that should generally behave the same, but are going to experience more movement. And so when you have first the concept of finding the boring stuff, you're hedged, you're looking at that relationship, then you can get some good trades out of it without having the directional exposure, which may be a problem, right? So again, we've always said that on Fed announcement, there is often a knee-jerk reaction.
Yep.
That knee-jerk reaction doesn't necessarily indicate the rest of the day's direction, okay? You could spike up and then come back. I've had it before where things have spiked down, spiked up, spiked down, and then finally settle into a direction. It can be very interesting. And this is an important announcement, and we are looking for clarity in language, and we're looking for clarity in direction. And that's just the market speaking when I say we, okay?
Yes, correct.
So let's look at this screen here. So StockOdds had some information for us for curating on the percent B. You choose ETFs. I trust you can see my screen okay. And you can look at, you know, a grouping, right? Find a grouping, look at its relationships. So we have GDX, GDXJ. So we got the senior miners, the junior miners, and gold. You can also throw silver into the mix, and there's a lot of other products around this area. One thing that Wall Street keeps on doing is creating more and more and more products for you guys. And so one of the you know, edges that pros generally look at, and retail, if you're sort of spreads orientated, is you look through these new products and existing products to see if you can find any anomalies, any edges, any mispricing. There's a difference on how stocks open versus how ETFs open, and there can be discrepancies there. You can do a cluster of stocks against an ETF, or you can do ETF against ETF. So pulling the odds here, GDX has odds of being up for the next 3 days. Again, looking at a little bit longer for those that swing trade, but it also applies to today. GDX a little bit less positive, and then gold being down. So when we see this, we go, okay, well, if gold moves down, which one does it tend to impact more? And I've seen a greater relationship between the movement of the gold ETF, which is a gold trust, and the junior miners being a bit more sensitive to that than the senior miners. Probably because the senior miners do more hedging, they do, you know, they're a little bit more diversified in some of the products rather than, you know, more pure plays. But anyway, there is a relationship. So that's the odds. But then you say, okay, you know, how am I going to trade it? When am I going to trade it? Well, that goes to looking at the relationship between the two. If you do have a way to look at spreads on your trading platform, or you subscribe to something, you know, it can be very helpful. So this is GDX and GDXJ. So that would mean that GDX is trading at a premium to GDXJ, right? So when you're approaching this, you go, hey, if I want it to be long, like if you go back to the odds, it might say, all right, let's be long GDX and short GDXJ, because obviously the odds are a little bit better. But if you use the expected value formula that I've been talking about, you would find if you multiplied odds by average performance, your outcome for GDXJ is a little bit more robust than GDX. So just at first glance, you know, you could have a takeaway of long GDX and short GDXJ. But if you look at the expected value formula, I would lean a little bit more to GDXJ. But regardless of that, they're both sort of heading the same direction over the next 3 days, is what the curated data says. So which one do you choose? Which gold is shinier, right?
Yep, that's the topic.
Which gold is shinier? Well, that's also related to what's your starting point with the, let's see here. What's your starting point with the spread? So how does this relate here? Let's go back to a daily and just see, where is this in the big picture? So over the long sample here, it's, in the upper third, and it's possible that it could push higher. But if you had a starting point to be long or short trading this, it's getting closer to that starting point of short the senior minor and long the junior minor, right? When you go in to look at how they're behaving today, you see that the junior minor is more discounted than the senior minor, right?
Mhm.
So that's the backdrop that you have to look at it two ways, and that is, what is the odds and sort of the backdrop from your indicators, from your signals and the subsequent outcomes, and what's the relationship at historically? Where is it? And how can I put this on and kind of trade around a core position from the right bias? So it's about getting that bias with a better probability. So as we've seen in this spread, it can move directionally, to some degree, but it stays overall in a pretty robust range. So it would be in the category of a relationship that would be more boring. It might not give you a lot out of it on any given day, but there are some days where it's going to be extremely directional. And that could happen even today. So again, you want a good starting point. And
Okay.
going back to let's go back to the 1 minute here. Actually, just take a 5-minute chart on this one. Give it a little bit more perspective here.
Okay.
So we were up pre-market, and then we kind of were down pre-market. So it's been a little bit all over because of the movement of gold, right? When you looked at all your ETFs this morning, did you notice that Kathy Wood's ARC funds were bid up a lot pre-market? XLK was doing fine, some discretionary, and you noticed that the gold and GDX and so on was indicated down quite a bit. So there was a lot of this reposturing this morning, selling some basic materials, buying technology, things like that, right? So as far as this goes, on a 5-minute basis, you can see that we're in a bit of a chop zone here, but it's at around the same level as it was yesterday and kind of the day before. And so you put on spreads not because you know where they're going to go. This is really important to remember. You don't have a guarantee. You put on spreads because you've studied the relationship, because you have some data, right? And so our data from the odds perspective over the next 3 days says that GDXJ on the expected value proposition says it should slightly outperform GDX. You also have to look at what's GLD doing. And if the market starts selling off more, GLD could become a little bit stronger, which can favor the GDXJ. It impacts it more readily. So this morning, GDXJ is down along in sympathy with GLD, right?
Mm-hmm.
So again, starting point is imperative, having some data to give you some confidence. And then the next thing is, don't put all of your capital that you would like to use on at one price. So imagine this for a second. Imagine that we put one on here because it's at an attractive level and because we have data. But let's say it rips up here and it stalls around this area. Do we have any numbers in the past that we can look at? And we probably do. So you put on another part of the intended capital. So now you're getting more towards what you wanted. You're in a loss on the first position. As you put your second position on, if that comes down to where around the area that you started with your first position, you could lock that in and you would have earned some money against your current holdings. It's not like dollar cost averaging. It's really about trading each layer or tranche independent from the other layer. So it's about trading each time you take the spread and keep that independent and don't include it in an average. What can happen with an average is it can be very misleading. It can be like a slow bleed where you keep putting it on and you think about your average price. It's much better to keep each tranche of capital completely separate and to try to make a profit on each one of those. So if this pops up here, and full disclosure, I do have this spread on, which I put on here before we went into the show. So I am short GDX and I am long GDXJ. Okay.
Okay.
So
All right.
if this goes up here, I'm not concerned because I actually would love that from a mean reverting perspective and from the odds that we have, that I would love to get something on up here. So if there's any way for that spread to go there, that would be great. Put one on and then trade as that thing moves around, trade it. Now, as we go into a Fed meeting, this spread will probably bounce around a lot. So we can look at how did it behave in previous spread or previous meetings, kind of go back through the spread and look at the different FOMC events and see if it moved around a lot. And if so, which way did it do? Because most of our Fed events have been what, Joel? Sort of more positive or
Yeah,
more
yeah. I think they've been.
oh,
Yeah, I mean,
over time. There's been a couple stumbling ones that we had, like October and so on, but September meeting maybe. But overall, they've been generally there's usually a little bit of too much optimism or too much fear ahead of them, right? Lately, probably too much fear. So we'll have to see, but this spread could definitely move around. There's other relationships, like you could do regional banking against money center banking. So that would be, and even in the regionals, there's a number of different regional products that you can use. So anything sort of interest rate sensitive, REITs can bounce around more, utilities can bounce around more. And if you guys are looking to, sort of get started with, StockOdds, what I would do is I would go up here into pairs and choose components and really work within the components, right? So
Rob, got a quick question here for you from Eric. Do you use any indicators such as Bollinger Bands on your pairs charts?
Yeah, in fact, years and years ago, there was a conversation that we had with John Bollinger himself. And when we showed him, this was my colleague that lived in Cincinnati, he was there and showed him the Bollinger Bands. It was at an expo, showed him the Bollinger Bands on pair charts. He said, remarkable. Because a pair is already statistically muted, you're getting +2 and -2 standard deviations and all of the variables that go with that, but you're getting it on a statistically muted product. So that's very different than a single directional product where you have to be a lot more aware of walking bands, band compression, which we call squeezes, and all that kind of stuff. So the pairs themselves, because they're statistically muted in a good relationship, I'm not talking about just throwing anything together, but two symbols that really belong together, that are mean reverting, that have a reason to be traded as a pair. If you take Bollinger Bands on those, they can be, a really good help. And when you're going into StockOdds and you choose %B, which is proximity to the band, right? Your percentage that you are to the band, lower band, upper band, or penetration of the band, then you're curating kind of that same information and the subsequent results. So if we explore this, let's see, what do I got here? Got to take your filters out to do this. But if we look at the relationships between AEE and XLU and AEP and XLU, we can see the odds of that relationship. And so by the Bollinger Band, essentially, it's like where it falls. And so what I would look for is, don't be afraid to sort of dig into your filter itself and say, okay, when I got a mean reverting relationship, the penetration of the lower Bollinger Band could be ideal. So this is minus 0.0932. So it went through the lower Bollinger Band as a relationship. And the odds coming out of that are 68.8 with average performance of 0.5810, positive sharp. So this is a real potential opportunity here for this thing to come back from that oversold condition and rally back over the next 3 days. I think we have it set for. So digging into here, you can find these more boring is beautiful relationships and work within the sector. And that's especially what I want to communicate for a day like today, where you have a major event. It's like, you don't have to have industry exposure. You don't have to go and just take hey, look at the people that said, oh, Microsoft was so terrible after hours yesterday, and said, well, it'll be even lower today, and shorted a big position for in the after hours for this morning. I think they were proven quite wrong. The thing is, you don't know when you're dealing with earnings, or you're dealing with potential investor sentiment change, or more explanation, or an earnings conference call where you hear analysts ask questions and things come out of that. So you just don't know. So when you don't know, and when there's concern, get into the groups and trade within the groups, and trade the noise, trade that elasticity, use the odds, but within the group itself. That way you don't have so much exposure, right? Okay. And you could also just take out, things like, if you're going to be in more boring, I would say, healthcare and industrials today and things like that were kind of opening, not at an extreme. You had the technology stocks opening way up this morning. And you had, like I said, gold and other things opening down. But there was a lot of stuff just in the middle, in like nobody cares area. Trade that. You don't need to go into the extremes and go like, well, I know that technology's got to come back down. It might. I mean, some of the edges are, when things are opening at a premium there, you go, what's mispriced. Even something simple like the Qs versus the XLK. XLK was opening up far more than the Qs were this morning. There's a technology relationship right there to exploit. So anyway, I hope I
covered a lot today, Rob. Thank you very much. Interesting looking at those spread relationships. So, all right, we're gonna wrap it up for today here, pre-market prep. With stock odds on this Wednesday, S&Ps, we're still hanging in there, still having a pretty good day, up 48 and a quarter handles, or right at 48 at 43.96, and giving some back off that high. So a little bit of profit taking after that big overnight move and big recent rally. The only thing, just a quick note here for, and Rob talks about, trying to take advantage of things at the open. If you just, if you had your blinkers on today, and with all the stuff with Microsoft, right, and getting killed in the pre-market, and then rallying in the after hours, and then, but if you could just filter out all the noise, and just really keep an eye on what's going on the open, you could get a pretty clear picture of what at least the larger traders or institutions are doing. I mean, this thing opened up, after the wild range it opened at 307.98. And you did go to 308.50, right? I don't think that I didn't have any daily levels there. But look what it did when it like even came back down. Like shorting it off the open, obviously you would have taken some, 52 cents worth of heat. But look how it reacted once it came back down through the opening. And I think, Rob, a lot of your strategies, a lot of things you execute on the open to try and, take advantage of those kind of moves. So
Well,
just
there's
one,
there's yeah, there's the opening trade itself, but then there's also the opening crossover move,
yes.
how things break out from the opening range, and literally, especially on gap opens, what you got to watch for is it gaps up, it blows off some pressure, right? It rallies a bit, and then it reverses and comes back through its open price. If you can get an open crossover move, so you say you have something on your watch list, you didn't deploy at the open because you thought, well, you know, I don't want to be short up here. It looks pretty strong, or whatever the reason was. But if it comes back through its open, that could be a really great trade. Now, it will be fast moving usually, but then you get your potential for a gap fill, right?
Yep.
Which is a
And
high probability trade by itself, right? So,
yep. And also just looking at that with the Microsoft, you had, right before the opening bell, you had a pre-market high at 308.75, and during the regular session missed that by only 25 cents with a 308.50 high. So okay, Rob, we're gonna wrap it up. Everyone have a great day. I'll be back at 3:30 to see where all this ends up with the Fed meeting. Thanks for joining us.